Hey there, and welcome to This Explainer. Look, if you're selling products online, you already know the universal headache that is e-commerce accounting. You make sales, you watch those dashboard numbers go up, and honestly, you feel like an absolute retail genius. But when it actually comes time to balance the books at the end of the month, the math just doesn't work. The numbers simply refuse to align. Well, today, we're going to completely demystify this whole process. We're going to help you find that missing money and firmly fix your financial foundation so you can just focus on scaling without the fear. It is quite possibly the single most frustrating moment for any seller. You log into your seller account, you see this massive sales number staring right back at you, and you instantly start planning your next vacation or maybe your next big inventory buy. But then you go look at your actual bank account and reality hits hard. The deposit is so much smaller. And you're left thinking, why doesn't my Amazon payout actually match my sales? Where did all that money go? It really feels like something is broken.
Okay, let's dive into this. What you're experiencing is a phenomenon known in the industry as the payout illusion. On one side, your seller dashboard is giving you the illusion of these incredibly high gross sales. You feel like you're crushing it. But on the other side, the bank is showing the harsh reality of a much lower net deposit. The truth is, you aren't doing anything wrong. But if you treat that net deposit as your actual revenue for tax or profit purposes, your books are going to be an absolute disaster. You're essentially flying blind, trying to steer a business without knowing how fast you're actually going or even how much fuel is left in the tank.
Let's actually break down the micromath of a payout to show you exactly where that money went. Imagine your dashboard shows gross sales of $52,940. Looks amazing on paper, right? But before Amazon ever sends you a single cent, they take their cut. They deduct FBA and referral fees right off the top. They pull out customer refunds and returns. They even hold back a rolling account reserve just in case of future issues or disputes. So what finally lands in your bank is a net payout of, say, $42,000. It's just one lump sum deposit, but 25 to 40% of your true business costs are completely hidden right inside it. To really make sense of this, we have to look at the underlying accounting rules that are running the show. See, Amazon relies on accrual accounting, and the absolutely crucial concept here is the vast difference between the accrual date and the due date. The accrual date is the exact moment someone buys your product. That is the economic reality of the transaction actually occurring. The due date, however, is simply when the cash actually hits your bank, which, as we know, could be weeks later depending on the platform's specific policies. Take Amazon's standard settlement cycle, for instance. It's 14 days. This creates a massive timing mismatch for your books. A sale might happen in week 1, a customer might refund that exact same item in week 2, and Amazon might finally disperse your remaining cash in week 3. A single transaction is now being dragged out across multiple weeks or even entirely different months. This timing lag is exactly why your daily cash balance is never, ever going to match your daily sales figures. You are constantly looking at a delayed reaction.
But here's the thing. This timing mismatch isn't just some annoying administrative headache for your bookkeeper. It can actually become a severe legal and financial danger. We call this the $90,000 trap, and it is particularly dangerous for sellers operating over in the UK. The absolute most vital rule to remember in e-commerce is this. Tax authorities tax your gross sale, not your net payout. They honestly don't care what landed in your checking account. They only care about what the customer originally paid. And here is how easily you can get caught out by this. In the UK, HMRC enforces a £90,000 VAT registration threshold based on a rolling 12-month period. Now, if you're blindly looking at your bank deposits to track your revenue, you're looking at the completely wrong number. Because those deposits already have all those fees stripped out, you're actually going to cross that £90,000 gross threshold much faster than your bank balance implies. And by the time you realize it, you've completely missed the mandatory deadline and you're facing some really heavy fines for late registration.
Once you do cross that line and officially register, you have to start charging the correct VAT rate. Most goods carry a standard 20% rate. Some qualifying goods like home energy drop down to 5%, and items like books or kids' clothes are completely zero rated. But, okay, here is the massive silver lining that so many growing sellers miss. Once you're officially registered, you can actually reclaim the input VAT that Amazon has been charging you on its seller fees. It is essentially unlocking money you left sitting on the table, turning a massive compliance headache into a sudden, very welcome cash flow boost.
All right, let's shift gears and look at the next major hurdle that absolutely wrecks your accounting. We call it the post-holiday hangover. You've popped the champagne, you survived the massive Q4 holiday rush, and your sales were totally record-breaking.
But then January rolls around and you get hit with a massive surge of returns and chargebacks. This entirely disrupts that whole reconciliation process we just talked about. It effectively turns last year's celebrated revenues into this year's massive liabilities. It's serious financial whiplash.
To manage this storm, you really need to understand exactly what's hitting your account. Chargebacks generally fall into 4 main categories. First, you've got outright fraud, using stolen credit cards. These are malicious attacks on your store. Second are legitimate disputes, where a customer actually received the wrong item, or maybe a broken product. Third are technical errors, like a customer being accidentally charged twice because of a glitch. And finally, there's consumer fraud, sarcastically known in the industry as friendly fraud, where a buyer purposefully abuses the chargeback system just to keep an item for free.
And the crucial takeaway here is just how incredibly damaging that last category has become for online retailers. Shockingly, friendly fraud now accounts for up to 70% of all return cases in the US. It's an absolute epidemic right now. And this destroys your profit margins twice over. First, through the lost inventory that you never get back, and second, through the massive, highly manual administrative workload your finance team has to take on just to dispute the claims and prove you actually delivered the goods. So because of all these moving parts, the hidden fees, the mismatched timelines spanning across different months, the complex tax rates, and that tidal wave of post-holiday chargebacks, trying to manage a growing e-commerce business in a manual spreadsheet is quite literally a recipe for disaster. Let's look at exactly why your trusty Excel file inevitably breaks under all this pressure as you try to scale.
Just think about the sheer nightmare of the manual workflow for a second. Every single month, you have to download half a dozen different platform reports. Then you try to standardize all the formatting so they actually match up. Next, you're looking up historical exchange rates line by line for international sales, you're manually adjusting for Amazon's rolling reserves, and then you just pray you can reconcile it all at the bottom. It is a frustrating, deeply error-prone cycle that fundamentally fails to give you a true, actionable picture of your actual financial reality.
When you rely on spreadsheets, you inevitably hit 5 severe structural limitations. First, Excel struggles with multi-platform aggregation. Amazon and Shopify simply format their raw data entirely differently. Second, it fails miserably at multi-currency reconciliation. Third, it cannot handle complex dynamic inventory valuations like FIFO or weighted average. Fourth, it leaves major gaps in multi-jurisdiction tax compliance, which we know is super dangerous. And honestly, most dangerously, it completely lacks data integrity. If someone accidentally deletes just one cell or breaks a formula, your whole accounting system silently breaks in the background.
The ultimate cost of all this manual work? It's your most valuable asset, your time. Businesses generating over $500,000 a year are routinely wasting 10 to 20 hours a week on these manual data processing tasks. That is half a work week that you or your highly paid finance team are spending hunting for lost pennies in a spreadsheet, instead of actually analyzing data, optimizing ad spend, or, growing your business.
So how do we actually fix this? Simple. We put down the spreadsheets and we adopt a professional accounting framework known as the clearing account method. This is the industry standard bridge that cures the payout illusion once and for all, bringing perfect clarity to your books. It's actually the exact foundational system used by major retailers but adapted perfectly for the fast-paced world of online sales.
And this brilliantly illustrates the beauty of the system, executed in 3 really simple steps. Step 1. Instead of just recording that net payout, you post the full settlement, the gross sales, the fees, the refunds, into a virtual clearing account inside your accounting software. Step 2. When Amazon's deposit actually lands in your bank, you record a transfer for that exact net amount from the clearing account over to your real checking account. Step 3. If all the math was done correctly, the clearing account nets out to perfectly zero. And that zero? That's the holy grail. It proves your books are entirely accurate and absolutely every single penny is accounted for.
Now, modern accounting software allows you to automate this entire clearing account process using 2 different sync methods, depending entirely on what your specific business needs. You can use a consolidated sync, which groups transactions by day. This one is perfect for high-volume sellers who just want a really fast, clean bank match without cluttering up their ledger. Or, if you need deep, granular reporting on specific products to see exactly what's driving your margins, you can choose an itemized sync. That one pulls in the individual line-level details for every single sale. The best part is, instead of building this complex system yourself, dedicated automation tools like PayTraQer, LinkSpring, or Datado can literally do all this heavy lifting for you. They sit seamlessly right between your e-commerce store and your accounting books to completely automate multi-platform data ingestion.
They handle multi-currency conversions instantly at the exact time of the transaction. They let you set specific clearing banks per currency, auto-detect those complex tax rules we talked about earlier, and they even flag any discrepancies instantly for review. It basically means no more spreadsheets and absolutely no more manual errors dragging you down.
Which brings us to our final thought for today. The gap between a stressed, struggling seller and a scaling, highly profitable enterprise, it is almost always financial clarity. So ask yourself, are you ready to stop hunting for missing cents in endless spreadsheets and start knowing exactly what makes you money? It's time to let automation handle the reconciliation so you can get back to handling the growth. Thanks so much for diving into this explainer with me, and I'll catch you next time.